Hi, Greg Dorsey here at Leeb.com, Leeb.com. Today's Monday, August 16th. Today's trading was about as odd as it gets. News that Japan's economy is just barely growing with a 0.4% GDP reading set the stage, putting deflation front and center in traders' minds, as if they needed a reminder after the Federal Reserve's policy statement of last week. The bond market had the strongest reaction, with the 30-year Treasury gaining 2.5%, pushing yields to their lowest level in 16 months. In the commodity pits, gold rallied nearly $10 an ounce to close just shy of $12.25 the ounce. That's less than 3% from its nominal high set just a little while ago. But the real kicker were stocks, which the blue chip averages closed flat on the day, and the small caps gained by a fair margin. Typically, when bonds are rising so strongly, it's occurring as investors flee riskier assets such as stocks. So it's highly unusual to see such a big move in bonds without a concurrent sharp break in equities. When it comes to economic forecasting, the credit market tends to do a far better job than the much smaller equities market. But perhaps the message of the stock market, which tends to discount events ahead of time, and as well as the message from precious metals today, is that additional steps to inject liquidity will be forthcoming, and that will ultimately be inflationary. More likely, there was essentially no volume to go along with today's trading, and the activity on the NYSE was the lightest of the year. So, given the recent technical action, we won't rule out the possibility that stock market investors' optimism will continue to wane and will revisit the lows down around 1,000 on the S&P before the Fed steps in and injects that liquidity to get things running again. So we'll see how this plays out, but it's certainly going to be interesting. Thanks for stopping by. We'll have more for you later this week.